Welcome back to Mortgagenomics Canada. I'm your host, Marco Gello. I'm a duly licensed mortgage broker in British Columbia and Alberta, originally from Calgary, currently residing in North Vancouver since 2011. If you're in either of these provinces and require mortgage service or advice, don't hesitate to call or text me right now at 604-800-9593, 604-800-9593. One application, one credit check, and access to Canada's top lenders. Today, I'm going to talk about debt service coverage ratios, what they mean, how they are applied when you qualify for a mortgage, and most importantly, how you can create more space within them, allowing you to qualify for higher mortgage amounts. In Canada's housing market, mortgage approvals often come down to your debt service coverage ratios. These are the payment thresholds imposed on us by lenders and regulators to make sure we can handle monthly mortgage and debt payments without stretching too thin. Let's first begin with the breakdown of the two main ratios and how they are calculated. So first thing to know is that there are two main ratios. There's the GDS, the gross debt service ratio, and the TDS, the total debt service ratio. The GDS looks at how much of your gross income goes strictly towards housing costs. That would be your mortgage payment, your property taxes, heating, and half of condo fees if that's applicable. For insured mortgages, less than 20% down payment, the limit is usually 39%, as in no more than 39% of your gross monthly income should be allocated for your mortgage payment. For conventional mortgages, which is 20% down payment or more, the limit can go as high as 48%, depending on your credit score and the loan to value ratio. Now, TDS, the total debt service ratio, casts a wider net. It includes all your debts, car loans, credit cards, student loans, all that on top of your housing costs. So basically, it's an extension of your gross debt service ratio. For insured mortgages, the maximum total debt service ratio is ranging from 42 to 44%, depending on your credit score. So no more than 42 to 44% of your gross monthly income should be allocated towards your mortgage payment, property taxes, heat, and condo fees, and all your debts that are registered in your credit report. So here's a quick example on a $100,000 gross annual income, and that's before taxes. The maximum GDS housing costs are about $3,250 per month. That translates to roughly a mortgage of about $490,000 at today's average rate of 4.5%. And remember, you always have to pass the mortgage stress test, which means qualifying at the higher of your contract rate plus 2% or 5.25%, whichever is greater. And in today's market, I'm using an average fixed rate of 4.5%, therefore a stress test of 6.5%. Okay, let's move on and get into the strategies to optimize your ratios. Keep in mind, for all scenarios, I am using an annual qualifying income of $100,000. Okay, so strategy one, pay down high interest debt. Credit cards hit your TDS hard. Even if you only pay the minimum, lenders assume 3% of the balance as a monthly payment. So a $10,000 credit card balance adds $300 to your TDS. Paying that off could boost your mortgage approval by $20,000 to $30,000 more. Strategy number two, use rental income. If you're buying a rental property or have a basement suite, lenders will credit anywhere from 50 to 100% of verifiable rental income toward your qualifying income. For example, with a 50% add-back formula for a basement suite, a $2,000 rental could add $1,000 to your qualifying income, potentially increasing your borrowing power by thousands of dollars. It's also important to note that the rental formula varies depending on the property type. Whether it's a principal residence with a basement suite or a standalone rental property or a newly purchased rental property. These rules can be complex, but the bottom line is clear. Rental income can be used as a qualification boost. Strategy number three, know insured versus conventional limits. With less than 20% down payment, ratios are capped at tighter at 39% GDS and 44% TDS. With 20% or more down payment, lenders can allow up to 45% for both GDS and TDS, especially if you have strong credit. That extra flexibility can boost approval amounts significantly. Strategy number 4, consider alternative lenders. If you don't fit the traditional box, alternative or B lenders may allow ratios as high as 50% or even 60%. The trade-off is higher rates and fees, but often as a short-term step before moving back to a major bank. Okay, let's now wrap this up with an example that articulates the impact of the varying allowable debt service ratio limits. Once again, the 3 scenarios I will display account for an annual qualifying income of $100,000 and stress-tested rates of 4.5% for the high ratio and conventional scenarios, and 5.25% for the alternative lender scenario. So let's start at the high ratio insurance mortgage with debt service limits of 39% and 42%. You'd be looking at a maximum qualification of about $422,000. For a conventional mortgage, the debt service ratios prop up to about 45%. This will up your qualification to about $540,000. And lastly, we arrive with the alternative lender with ratios as high as 50 to 60%. This could bump you with a mortgage as high as $700,000. So in all 3 scenarios we're looking at, the same income, the same person. The difference comes down entirely to which ratios and rules apply. And just to be clear, all these numbers are based on the mortgage stress test, which requires qualifying at the higher of your contract rate plus 2% or 5.25%, whichever is greater. And as I mentioned, for the scenarios above, I use stress tested rates of 4.5% for the high ratio and conventional scenarios and 5.25% for the alternative lender scenario. So optimizing your debt service ratios isn't just about numbers, it's strategy. Paying down debt, using rental income, understanding lender rules, and considering alternatives can dramatically change how much you qualify for. Too often, borrowers derail their approval by over-focusing and emphasizing on interest rates or relying solely on inside-the-box pre-approvals. Strategy-based qualification, the kind that considers debt paydown timing, rental income use, lender policy differences, and product flexibility, can unlock significantly more borrowing power. Ignoring these strategies in favor of chasing the lowest rate is one of the most common missed opportunities. And the sooner you get approved strategically, the sooner you start building equity and benefiting from appreciation. If you found this helpful, please make sure to like the video and subscribe for more mortgage qualification insights. Thank you again for tuning into Mortgagenomics Canada, everyone. Stay well and talk again soon.